So, hi, Professor Rahul. With the current situation that India is going through, I think what should an investor look for when he's investing into India?
That's a really good question. Today when we are looking at India, we are not the only ones. See, the whole world is looking towards India for growth. When you're talking about IMF, even IMF is like, okay, it's going to be the growth engine for the world. You have a lot of things which have happened over the past, 4 to 5 years. There was obviously GST implementation that took place. There was, something which is called as, China Plus One concept, which came into play. There was PLI scheme, which is your production linked incentive scheme, which was basically formulated by the government and put across. So what all this has done is it has brought India right in front of the world for manufacturing. And when there is manufacturing, please understand, even today, India is consuming 2/3 of what it's manufacturing. So we only have 1/3 to basically give away to the world, which means that we are really manufacturing good stuff, which is being consumed not even by Indians but also abroad all over the world. The supply chain management, alignment, which was only restricted towards China, has now slowly the cameras have come towards India, which has been a very, very big thing for us. Obviously, a stable government, the rules and regulations which have been implemented has been an additional positive. We have the youngest generation today. We're talking about an age group of 27 to 34, almost 60% of us, which means that we are consuming, we have lifestyle parameters which we have kept for ourselves. So there is going to be spending. Consumption is going to be one of the major driving forces for India. Having said this, we are moving from a $3 trillion economy to a $6 trillion economy. I think that's going to be over the next 6 to 7 years. We've already crossed the 3 trillion. You're looking at per capita income growing from 2,000 to up to $5,000 dollars per annum. So I mean, you're in a situation where there's going to be a boom, which you saw in USA during the 60s and the 70s, and then there was obviously China during the 1990s and 2000s. So we are there. So yes, India should be the right place to be investing for the long run. Please keep 7 to 8 years in mind, and then that's going to be the fulfilling factor for you in terms of an investment. Align your goals when you're looking at India.
From an investor's point of view, there are a lot of avenues available for investment. So according to you, where should one invest and why?
Okay, well, this is again a brilliant question. You need to understand yourself. Where are you? Are you a risk investor or a non-risk investor? Okay, what kind of tax liability you are really at in terms of your income? I think the third parameter is your age, which age group you're basically are at. When I'm saying risk and non-risk, the reason is very simple. When you talk about non-risk, obviously the growth is nothing great. You're looking at 6-7%, but that's exactly what your inflation is. So the real growth of your money is nothing. So you're parking something like 100 rupees, you make 107 rupees, but what you're able to buy today in 100 rupees, after 1 year, because of inflation, any which ways, it's going to cost you 107 rupees. So it doesn't make sense. Second, when you're talking about risk asset, risk is nothing but uncertainty. When I'm saying uncertainty, what I mean is you don't know at the end of 1 year what kind of a return you're really going to get. But this uncertainty can be, I wouldn't say totally mitigated, but it can be reduced drastically if you put in a good time frame into the picture. When I mean time frame, you can look at 6 to 7 years minimum. So in risk assets, you have equities. So if you can take a little bit of risk, you go into risk assets like maybe parking your money through mutual funds, direct equity, gold, silver. You have your real assets like maybe your land, commercial properties. But if you're not very risk oriented, you don't want to have risk in your portfolio, then you can go in for debt in mutual funds or fixed deposits. You have PPF, you have insurance endowment plans which you can park your money. But if you ask me personally, you need to have a mix of both of them, taking into account your age and the time frame of your goals, which might be long-term, medium, or short in nature. So mix it up a little bit. Make sure that we have got risk and non-risk so that your average returns should be close to 10 to 11%, which makes more sense. So that's how you basically create a portfolio and move forward in life.
So when it comes to investor behavior, I think there are three things: fear, greed, and overconfidence, which people actually look at. Or rather, these are the three parameters which are predominantly forming part of the investor behavior. According to you, what should be given how much weightage and why?
That's brilliant. Actually, every investor today has come across a certain time phases when they entered the market and invested. So if you would have come, just after 2020, after the health, care crisis COVID, you would have made brilliant money in within a year's time. So that's where you would have thought, okay, it's such an easy way of making money, and that would maybe have gotten this greed, which would have set into your and overconfidence that I can do it on my own. But then suddenly you're in 2022 and end of 21 where it did not work the way you would have thought, and that would be the fearful. Fear would come into the picture because suddenly you're not making the kind of money you have made over the last 1.5 years, and then you're losing money. So please be very, very careful when you are judging these 3 parameters within yourself, because every time frame requires a certain degree of all these 3 parameters. You can be greedy. You can be greedy, but then you need to see what valuations the markets are. If they are really at the lower end, that should be market watering for you. When I'm saying valuations, you look at price to growth, you look at the price to equity, you look at the earnings per share, you look at the beta levels which are there, the dividend yields which are prevailing at that point of time. That's when you need to be greedy. And the other part where you become fearful, well, again, you need to be very clear that there are times when you should be fearful, because I personally believe that the 80-20 rule, wherein the 20% of the rally in an equity market takes 80% of the time, and that the 80% of the rally in the equity market just takes 20% of the time frame. So that's the last end part where suddenly you see the indices moving from one major hurdle to another in a very short period of time. So that's when you need to become very, very fearful. Like if Nifty moves from 20,000 to 21,000 in say like 2 months, and from 21,000 to 22,000 in like a month's time, okay, that should alert you immediately, because certainly there's a lot of movement which is unprecedented, and valuations are not basically at par. The third one, which is overconfidence, well, that's one of the things which you can never have in your life. I mean, it should not be a part of your life at all. You can be fearful, you can be greedy, but I think the most overpowering factor in our decision making is overconfidence. Overconfidence and greed is not good. Overconfidence in being fearful is also not good. So keep that totally aside, and how you go about doing it is obviously not letting any bias of surroundings coming into your mental capacities, looking at valuations more judicially, and having your own stop losses and financial goals in place, so that you don't get overconfident, because that's where you basically go ahead and become risk free in your thought process on your investments. So be fearful as per the time. Be greedy as per time in valuations. Overconfidence, never, not even in your life. That's what I would suggest. Thank you.